Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market update for Monday, April 8th, 2019. Not really an update because we don't have anything to update. The SPY was flat today. The broad market itself, the S&P 500, I'm showing the SPY up 0.08%, so less than 1/10 of 1%. That's a flat close for all intents and purposes. But what we're going to talk on today, we're going to go through, from time to time I like to take a quick look at the 11 sectors that make up the stock market, or the S&P 500, which is the truest measure of any one index of the U.S. market. Given that it excludes large caps and mid caps, however, you have 11 sectors. It's well balanced, diversified. Most of the big market leading companies are in there, and if any one index is the stock market, this is as close as it gets. So we'll look at the 11 sectors. A couple things I want to point out there. And then I'd like to talk a little bit, and I have a couple charts to show you. Some developments with the really low volume we're seeing lately. There's a couple of interesting points there I want to point out, and if maybe I'll get to the percentage of stocks above their 200-day moving average. It's one of many breadth indicators, and I wanted to look at that if there's, again, time permitting. So we'll start out here. We'll just run through the 11 sectors pretty quickly. I'll make the points I want to make, and then try to get to those other things. All right, so let's look at the stock market before we dig into the sectors. Let's just do a quick update here. The S&P 500. There's our top back here on what day was that? October 2nd, I think. Trying to grab that. There it is. Got the top of the candle, and yeah, that was actually September 20th, right there on the S&P. So there's our all-time high, and right now we're about a little under 2% from that all-time high. So we're still below it. Let's talk about I can sit here and go over the same things I've gone over in recent weeks. We have the negative divergences forming, and they just continue to build, but that's not anything new. Before we dive into the 11 sectors, let's just take a look at what I'm watching, and have been since last week. If you recall in last week's analysis, there's a couple levels here. We had two things happen last week. We had these uptrend lines break. These are just minor uptrend lines here on the 60-minute chart, just like a minor uptrend line here that was broken and back tested, breakdown, back test, correction, minor uptrend line there, breakdown, back test, correction. And then we had this one breakdown last week, and my first support level, first target was hit almost to the button there, 28.6871, and that's still the low. Well, that's not 71. The ES only prints in quarter point increments. Remember, this is the S&P 500 E-mini futures, so that would really be 28.6875, we'll call it, and that's it. So we hit it. We've grinded slightly higher, and all we've done is extended the divergences. So they haven't really played out yet, and nor will they until we take out that support level right there. So that's still a level we're watching right now, or I'm watching, and until and unless that goes, we continue the slow grind higher. NQ, same story. We had the 60-minute price channel right here. You can see that was highlighted last week. We broke down there and went on to hit that first target I had to the button, also about 75.1950. Reverse from there. We've pretty much only moved sideways for last week. You can see if we really look at this range right here. But what we did today, same story as lately. We just inched higher, made a marginal new high, slightly higher high, to just simply extend the divergences that were in place. Both ES and NQ, we're also seeing these trend indicators, these 60-minute PPO lines above the zero line as of now. So those are things we watch. That would be if you're looking for a sell signal or any kind of warning sign there in the futures, you want to see that level go about, we'll call it 75.19, give it a little bit of cushion there. But as of now, the trend remains up. So let's go look at the sectors in the S&P 500. Okay, and again, the stock market is simply a sum of its parts, and those parts are really thousands of different stocks and companies in many different sectors, but the S&P 500 consists of 11 sectors or primary sectors. Within there we have subsectors. For example, technology is the largest sector at about almost a 20% weighting. So 1/5 of the returns come from technology sector in the S&P 500, nearly 2/3 in the Nasdaq 100. And within technology, of course, you have different subsectors of tech, like the semiconductor makers, the hardware makers, and software and different things like that. So let's look at these sectors. We'll go down this list in order. It's sorted by their weighting. So when you get down here, just remember as I go down the list, you can add up the bottom few sectors here, and they don't even put a dent in the performance of the index. These are on average about 3% right here. So you add up the bottom three and you're talking less than 10% in this one sector. The top sector alone is double those three combined, and therefore it's going to have a lot bigger impact. So keep that in mind as you go down, and that's why, again, why I'm doing this video. Now, if you recall, if you were following the site back here for weeks on end, this is what we were watching, and I continually said the same thing. The market won't break until tech breaks, but when tech breaks, the market will break. And when did we get that sell signal? We were tracking that trend line, that wedge right there. It came right there on that date, and to be exact, that was on October 4th, and that was the day after the at least the tech sector, and I believe QQQ would have topped right there. Came clean, nice impulsive breakdown, impulsive follow through, everything you like to see. So the story was then, just as is now, we have negative divergence. We have, if you look at this chart, we're spanning back a couple years here, and you can see they're marked up here. We have 4 divergent highs, one that's in process right now. And don't forget, divergences are not a sell signal. Far from it. They're merely an indication of an impending trend change, or that a trend change is likely. Your sell signal comes on breaks of uptrend lines. Back here we were focused, I was covering on a near daily basis, uptrend line on the 60-minute chart. The day it broke is the day that I gave a, put out a post, major sell signal in the U.S. markets. That's when we had that first big correction, biggest one in years. And then what happened from there is we pushed up. We extended the divergences, and after covering those shorts and even going long here on that rally, we then had another opportunity. We shorted again. That was a second divergent high, and there's your second big correction, again, biggest in years. And then what happened from here? This is a good example of why divergences are not a sell signal. We had a series of divergent highs along the way, 1, 2, 3. Each one gave a little correction, little pullback, but you can see the nature of a wedge. You have smaller and smaller, prices contracting. So it's not as if these divergences didn't play out. They did for relatively small corrections till you built a larger divergence right there, and then finally you gave way. The big trend line, the primary uptrend line, broke, and this divergence was simply one large divergence, a combination of the previous two, and all three of these together. And again, that led to the big drop there. So what do we have now? Again, we have divergence. Is it a big divergence? No. Recently we only had divergence on the PPO. Now we have it on the RSI as well. And like any divergence, it may want to play out, it may want to extend, as long as we continue to make equal or lower lows on the, or lower highs on the indicators, that divergence is intact. So take it as you want, but this is what I'm watching right now. And I'll say the same thing as I did back then. Until and unless tech breaks, the market won't break. When tech breaks, the market will break. That is my strong belief here. And so I'm watching this line. I have a similar uptrend line on QQQ. You can see it off the lows, 1, 2, 3, 4, and maybe a fifth reaction. We'll see. So this is one level I'm watching right now. We'll look at other things, and we'll look at the nature of it. If it breaks down, is it an impulsive breakdown? Do we print a close below it? Is it a solid close, or do we park it right on there? So there's a lot to go into that, but again, this is an early heads up that we may see a trend reversal. And until we do, until then, just a slow grind higher is what we're looking at here. So let's look at the remainder of the sectors here, and let's move this off to the side here. XLV, second largest component in the S&P 500 at about a 15.2% weighting. Let's get rid of those trend lines. Just look at the bigger picture. Healthcare stocks really topped earlier in the year back here. Actually, they had almost a double top here, October and December. So that's about a double top. And so far, they're still below those highs. So We have one, two, few reactions. We're starting to make a series of lower highs here, but I wouldn't call this a downtrend because we don't have a series of lower lows. That is the definition of a downtrend, a security making a series of higher lows, or an uptrend I should say is higher lows and higher highs, where a downtrend is lower lows and lower highs. So we don't have that. We really have neither right now, at least from this time frame. However, I just wanted to point out that unlike the broad market, this second largest sector is still pretty comfortably off those highs, about 4.18%, because again, tech is what's driven the large market, the broad market up. Tech and really the consumer discretionary stocks to a large extent as well. So there's XLV. Here's XLF, the financials. This is the third largest component. It's about a 14% weighting, so definitely a significant component to the S&P 500 one you want to watch. And this one is still well off its highs, and you can see here, just a series of lower highs so far. Again, we had those lows that kind of throws everything off. But overall, if you look at it this way, we're still in a downtrend like that on the financials. And again, we're still well off the highs. Let me put this back up. Nope, let me go back here and just measure it for you and just tell you how much, again, the third largest sector is. It's still down 12%. So the financials aren't anywhere close to making a new high anytime soon. Again, it's tech that's been pulling this market up. XLC. This is a new sector. This replaced the old telecom sector that had been around for forever and a day. Times are changing, so the old telecom companies aren't. They're now more this communication services, and that was a brand new sector back last year. Now you can see that sector peaked shortly after it came out, and it's still well off the highs. Again, this is a significant weighting. It's a little over 10%, and we're still about 7% off the highs. And here's a price channel to watch on that sector right now. And there's your divergence down below as well. All right, next up, XLY, consumer discretionary. This and tech, those two alone, you take them out, this market would be still well and solidly in a bear market right now, and without be clear, crystal clear. However, consumer discretionary, and this is an important sector, economy, the one thing that's really been holding this up, we're getting a lot of mixed signals in the economy now, but one thing that's been strong is the unemployment rate, undoubtedly, and that, of course, has buoyed the, consumer spending, and consumer spending makes up nearly 2/3 of the gross domestic product, GDP. So when the consumer breaks, that's when the market breaks as well, or the nail in the coffin, I should say. Now, just a breakdown in tech, like we had last quarter, that was what triggered the whole meltdown. And those tech stocks, those are your market leading FANG stocks. They're too top heavy. They've once again, just like they were back then, they've been lifting the market. It's simply a crowded trade. Do not try to overestimate that. Don't try to put fundamental analysis into it and reasoning, logic, why they should or shouldn't continue to go up. It's just that simple. When they break, technically, and the trend line I showed you, and the money flows reverse and go the other way because it's a crowded trade. That's where everyone's been cramming into, especially the institutions, because we're not seeing the growth in the vast majority of companies right now. It's those big tech companies that are the earnings juggernauts, and so that's where the hedge funds and the S&P 500 index funds, that's where everything's been going, and that's what's driving us in XLY. So here's XLY. Just wanted to share. You can see the wedge, 10% weighting, almost to its highs. We're virtually right now, yeah, we have a double top today. Let's say that's doesn't matter if we're exactly to the penny. That's where we were back then. You can see down below we have the divergence on the PPO, but not on the RSI, but we just have an overbought reading. So we're going to watch this one as well. Again, the more check boxes you can check off on these sectors breaking down, although I'm putting a big weighting on tech, obviously you want to see XLY go as well, because it is, again, a 10% weighting and been one of the stronger sectors lifting the market up. XLI industrials, that's about a better than 9.5 or so percent weighting. Let's take these lines away and just look at what that one's doing technically. You can see it peaked all the way back here in early 2018. This high was a little bit lower, and so were these two right now. So virtually a double top high there. We can draw if we want to, you can tell that if this one pushes up any higher, even at this point, I should say, we have almost equal highs right there, and you can see these indicators lagging. Now, they haven't confirmed the divergence. PPO is still moving up, and I'm going to jump to the weekly charts in a second and really paint the bigger picture. But right now, I just wanted to mention that here is the industrials. This is a sector, one of the leading sectors of the economy, and it's still down almost 5% off its highs after peaking out almost a year and a half ago. XLP, consumer staples, let's see, that is a 7% weighting. Remember, we're going down the line here, so it's not going to make as big a difference to the index as, of course, as technology would, but still one worth noting. And again, the point I'm doing this is to drive home the point that it's really those two sectors that I showed you earlier, consumer discretionary and tech, that's been lifting the market. Here we are making a series of lower highs so far. And again, these are things you look for. If in 3 weeks or 3 months I'm doing this video and all of a sudden XLP and a lot of those other sectors have taken out those previous reaction highs, well, hey, that's a check mark. Check mark for the longer term bullish case. It's showing those previous reaction highs are getting taken out. Otherwise, if we fail here, go back down to whatever level and come back up and make a lower high again in reverse, that's all the makings of a downtrend so far. So point is, out of the 11 sectors in the S&P 500, almost all of them have clearly topped at this point. Maybe that proves to be otherwise, 3 months, 2 months, 6 months down the road, but as of now, a lot of these sectors like this one are well off their highs. As of today, XLP is down still 5% off the highs, and that high, remember, came over a year, almost a year and a half ago, well over 15, 16 months ago. XLE, 5.5% weighting, so we're getting down the line. This used to be one of the biggest, if not the biggest sector in the S&P 500. Seems like not so long ago, but I guess it has been 10 years or more. Let's just take off these annotations and show you that, despite the strong run in oil lately, this sector is still sucking wind. You can see that energy topped quite a while ago, and it's still well off the highs. I mean, if we look at just the 2018 highs right there, this sector is still down 15%, and it's got work to do now. It actually topped. Energy has been in a bear market, clearly in a bear market, since 2014, and that just tells you, it tells you something about the economy. It just shows you that things have really changed in the stock market, and it's all about technology and not just tech. Because I can sit here, and I don't have time in this video, but I've done it. You can do the same. Go into QQQ or the Nasdaq Composite and look at the top, look at the performance. What I did earlier today is I sorted both of those, Nasdaq Composite and QQQ, by market cap, and I went down the charts real quickly. Top components, top 10 or 15, and then the bottom 20 or so. And the bottom 20 or so are all in bear markets. So far off that, still most of them 20% or more off the highs, and it just shows you again, and I'll get to something in a minute if there's time, the percent of stocks trading above their 200-day moving average, that shows you it's fewer and fewer stocks. So we're seeing breadth deterioration and volume declining as this market lifts higher. What's carrying it up at this point? I don't know. There's a lot of articles written about it, whether it's these stock buybacks or what, but there have been record outflows of retail money coming out of the market since December, and yeah, something's lifting this market, but it's not. There's a lot of red flags flashing right now. XLU, 3% weighting in the S&P 500. It is one of only 2, I believe, right now at new to all-time highs, and that again, it doesn't even make a difference because it's a 3% weighting. It's not going to have much of an impact at all. Actually looks like it's in, was pointed out here, divergent high already broke down. Again, let's not spend a lot of time on it because other than trading it or trading in the individual components, there's just not a big impact on the market. Same with real estate. The REITs, 2.62, less than 3% weighting, and then XLB, basic materials, only under a 3% weighting. But this kind of tells you something about the economy too. How strong is the economy if basic materials are in a bear market, or at least in a, yeah, like I said, you can question it, but you can see so far a series of lower highs with basic materials clearly peaking back in the beginning of 2018. Again, coming up not quite a year and a half yet, but we're still down 10% from the highs put in, over 15, 16 months ago. All right, let's just run through at least the top of these very fast and on the weekly charts, because this paints the bigger picture. We had a divergent high there, correction, kickback rally. We haven't even back tested there. Again, we're coming up to those previous highs, but just as we did back here in 2015, and that was followed by another big leg down. And so it's still anybody's game, that's the point. And there's your steep uptrend line. Again, I had that on the daily chart. You can draw it there as well. Here we go. So this is what you want to watch. And again, when tech breaks, the market breaks. So that's tech. Healthcare. This one's already broken, back tested. And there's just clear as day. Big divergent high, 27% drop. Big divergent high, breakdown, and a back test of the primary trend line. So this was a correction in an ongoing bull market back here in 2015. This is your bull market uptrend line, which has been broken and back tested. Big divergences at the high, so we'll see where we go in the next few months. But that's the second largest sector in the S&P 500. XLF financials, this trend line has 3 reactions, but again, I already went over the point that they topped way back here in early 2018. Still well below it, and we'll of course watch that trend line if we get there soon. XLC hasn't been around long enough to chart it on the weekly. XLY, again, this is the only other sector that's the only one holding the market up, I should say, because of the heavy weighting. It's the only one besides those utilities and REITs that are down there at the 3% range, as far as our market cap, or their weighting to the S&P. This is the only other one that's at or near the all-time highs, the previous highs. And you can see same story as healthcare stocks, breakdown and a back test of the primary trend line right now. XLI industrials, there's your bull market uptrend line, there's your divergent high, breakdown, hasn't even back tested yet, still well below there. XLP, staples is just a dead money sector for what, years now. Here's our range right here, big sideways trading range. Hasn't gone down, hasn't gone up. There's been some swings from the top to the bottom of the range, so make of it what you will. XLE, again, I already talked about it. You can go to weekly chart. You can see this is the peak back here in the energy sector, top back in 2014, and it's been working its way sideways to lower since. XLU, utilities, not that it's going to have a big impact on the market, but they broke down, back tested. There's slightly, but for all practical purposes, they're really right up on this trend line here. Depends how you want to move it around. Looks like they're back testing. XLRE, again, this one hasn't been around long enough. If you want to do a long-term chart on the REITs, pull IYR. It's another REIT ETF that's been around longer. And then finally XLB, basic materials. Don't see much here that stands out on this weekly chart, but again, you can see still well off the highs in early 2018. And that trend indicator here, by the way, the PPO signal line, still below the zero line, just as it was here during this bear market, or drop of 20% or more, as well as this one and the one before. Okay, here's a chart. This is Nasdaq percent of stocks trading above their 200-day moving average. This goes back and covers the last bear market, and you can see all my lines. The blue lines are divergence lines. You can see up top we have the Nasdaq Composite Index. Down below, the percentage of stocks trading above or below their 200-day moving average. So technically, the top end of the scale down here would be 100, and the bottom end 0, because you can't have more than 100% of stocks trading above a moving average, nor can you have them less than 0. So obviously, those are theoretical bounds, but you're never going to have all 100%. You almost had it back here. It came darn close. 80 something. And at the end of the last bear market, or actually back in the October lows, that's when the Nasdaq bottomed, actually, is before the rest of the market. You were down close to only 5% or so. We're trading above their 200-day. But the takeaway from this, forget about the ranges and the extremes, are just those divergences. And without fail, here's this is a chart I've shared in the past. It just tells you when to, look for a major correction, and it's those divergences between that. So what it shows you, this is a simple market breadth indicator. When the stocks are rising and the number of the stocks in that sector, or index in this case, are above their 200-day moving average is falling, it tells you simply that fewer and fewer stocks are carrying the market higher. And there's your corrections, simple. Some bigger than others. Sometimes you get these continuation of the divergences, just like you had here. You had the first shot across the bow and the second one. I haven't even updated this chart in a while. Last time I put this arrow, we hadn't even topped yet, and I just said the top was coming, most likely because you could see leading up to the highs and August or so right here when we peaked right here on the Nasdaq, and August, September, whenever it was here, you can see that we had severe divergence between the number of stocks making new highs. Now, where am I going with this? All right, let's say, so look, we're rallying strong. We've had a pretty good lift, especially in the tech-heavy Nasdaq stocks, but we're still, remember, QQQ, and unfortunately I don't have a chart, and I don't believe there's one out there that will show you the percentage of stocks in the Nasdaq 100 trading above their 200-day. Remember, the Nasdaq Composite is not the Nasdaq 100. The Nasdaq 100 is just the 100 largest stocks within the Nasdaq. So this is a bigger universe, and this is usually what you'll get your index feed from. So, but we do know, and again, well, that's other proof. You can compare the Nasdaq to the Nasdaq 100, and you can see that the Nasdaq 100 is just a day or two away from making a new high, but yet look where the percentage of stocks are above their 200-day moving average. More than half are below their 200-day moving average right now. And again, if we look at here, let me just show you what we need to look at here to put that in perspective. We need to look at QQQ and show you on a daily chart that here's our 200-day, right where the crosshairs. I have a red line here. If you can make it out, I'm putting the crosshairs. There's our 200-day moving average. We are 8.5% above the 200-day moving average in the Nasdaq 100, and yet over half the stocks in the Nasdaq Composite are below their 200-day moving average. In fact, let's look at the comp. Here it is, the Nasdaq comp. And again, you're going to have the same heavyweights in here that you have in QQQ. Apple, Amazon, Facebook, you name them, they're all in here. And they're lifting the Nasdaq Composite up to within 2% of its all-time highs. Yet over half the stocks are trading below their 200-day. So that shows you just how big the impact is on a handful of those mega cap stocks. And bottom line, it's just not healthy. It's not a healthy stock market. It shows you most stocks are falling or lagging or still in bear markets. And it's the same thing we saw leading up to the highs in 2007. One other thing I wanted to note too is, if you look, we haven't had a bear market since back here, but the last big correction near bear market that we had was back in 2015. And so what you can see is when the market topped right here, there was our top right about this level, and came up and made, just like now, almost an equal high. It was just a hair below or right about where we are as far as retracements that last one. And so if you look at this point, I marked the high right here. So there's where the percentage of stocks above their 200-day moving average were. And on that first kickback rally, again, comparable now, you can see they were severely lagging. So if the index itself came back to where it was at that point, in a healthy market, you would think that the same number of stocks would be above their 200-day moving average. But what you had here is severe divergence. You could see it lagging back then. And then what happened because of that divergence? Bad market breadth, boom, another leg down right there. And so now when you fast forward a little bit, well, we had that second correction. So again, let's mark that high right there. And then it took all the way up to about this point right here for the Nasdaq Composite to get back where it was again at this point. So these are the arrows, these are the points I'm using right here. That top back in 2015, and it took this long, it was over a year and a half to get back there. Now at that point, we went from there to right about here. In other words, the percentage of stocks above their 200-day moving average was above where it was back then. And I went back at all points in times and see similar things. So right now, with the market being up almost to that high, that previous high there, this line right here should be much closer to where it was. Oh, you know what? I need to add a line. Let me do that to right here. That was, we'll just put that arrow tool there. So that shows you, and again, I just showed you in many different ways that breadth deterioration is occurring, and it's fewer and fewer stocks lifting up, which isn't healthy. Like we saw at this point in time in this rally, we did have more stocks above their 200-day moving average than were at the previous peak, and that set the stage for a nice healthy rally there. Okay, finally something that I haven't, I've talked about it recently, the low volume, but I haven't put up any charts on that. In fact, I used to track that fairly regular, not all the time because you usually don't get these sell signals. This, I did a search on my site, the best I could find the last time I put these charts up, and again, time flies, 2015. And as you know, as I showed you a minute ago, the biggest, by far, the biggest correction both in time and price that we've had since the stock market began, other than this drop last quarter, of course, was that big drop back in 2015. So back, and you can see the charts are always time stamped on the site. End of April 2015, shortly. I posted this one, IWM, SPY, volume plunge, correction likely. And what I did here, let me show you these charts here. Let's just take a look at it and show you if I can get this up there for you. There we go. I put a line right now. I'll use a 10, anywhere from a 5 to a 10-day exponential moving average, and overlay that on volume. That's what I did back then, and I'm going to show you that in a second here with today's charts. And so then I'll look on the chart. Now, over time, market conditions change, volume levels change. So the levels that I used back then are irrelevant. So that the level of that line is not very relevant today, but it's more so when you take that line and put the EMA on the volume. I use an EMA because if you look at individual volume spikes on each bar, you're going to get whipsawed to heck. You're going to have holidays, you're going to have certain days for whatever reason have low volume. So an exponential moving average will help smooth it out, but I like to use the exponential moving averages because they move faster, they adjust faster than a simple moving average, and that's why you'll see usually EMAs on my charts, at least especially on this one. So you can see that I pointed out, and these were the red corrections that we had here, and again, this was back then that we hit these danger levels. So I put these horizontal lines and showed you that sometimes you had these persistent low volume levels, and all these big corrections came. And again, low volume, just like divergence, is not a sell signal. You had a wedge here, which we were working its way up, but I marked that or highlighted those low volume sell signals, and really it works great in IWM too. Here's IWM back then, and again, you can see the lines. So let's take a look at today's, and remember again that we did experience the biggest drop in the market shortly after this, and it also lasted well over a year and a half of sideways trading in the market. Okay, the video is going a little long, so I'm not going to go over the S&P and all the other indexes. We'll just look at IWM here because this is one, like I said, it's always worked well on. And you can see, so here's the orange line, let's call it the danger zone when volume plummets. So I'm just going to circle. Sometimes it's not a one and done. Sometimes it can be a one and done when you get down there, but sometimes volume goes low and it stays low for a while. Sometimes it'll even dip below the line for a little bit. But you can just follow these up and look what happened at those points. So I'll just show you this top here. We had a correction, came back in, had another low volume, and then another correction there. Everything's hunky-dory, volume's good, the market's rising, we're rallying, everything's good. Right here, oops, let's go back there, we missed one. There was a plunge in volume, hit the orange line, told you, hey, watch out, something's amiss here. Let's try to box it in there for you. And that came right there just before this drop here. Okay, so you can see again, came low, volume went low, there's our drop right there, low volume right there, up until this point, there's our drop, low volume right here. We had a little correction there, but we stayed persistently low. So this was a little warning shot with a little correction there, but we got really low right here. Uber low volume leading up to the top. In fact, you can see from this, and I'm using a 10 period EMA on this one, that was the lowest volume below that line, extreme low volume. And what did you get out of it? An extreme correction, or crash, if you will, in IWM. What do we have now? Well, we hit that level right here recently, right before here, leading up to this top. We had in fact, let's zoom it in tighter. There was our low volume warning. It hit right there, tagged the line, little before the top, stayed very low, and so far that was the top in IWM, and IWM is still clearly below that level, and it's making another run down here, low volume once again. So again, I've said this for weeks now. You know, the SPY closed above that 282 level, but before it even happened, I said if it did, it doesn't flip me just because of that from bearish to bullish. There's a lot of other things we're watching right now. Auto parts stocks, you know, lithium stocks. We've had a handful of those just, you know, explode lately to the long side. So things that aren't related to the broad market or highly correlated, that's where my focus is. Commodities, other things like that. As far as the broad market goes, it can go to the moon. It can burn through these divergences. It can all of a sudden pick up in volume, or maybe these low volume sell signals don't pan out. And if it does that, great. But as of now, there's just too many red flags across the way with both divergences, breadth deterioration, low volume, you name it. And the more that continues, it sets the stage for not just a correction, but a big drop. And therefore, it just means the risk reward is not very attractive right now for things that are highly correlated with the broad market, including those market leading FANG stocks. So let's watch the levels on XLK, tech sector, and you know, some of those other sectors that I pointed out, and yeah, and then we'll go from there. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.